Okay, good morning, everybody. Welcome to Understanding Indexed Universal Life. My name is Lynne Celia, and I am a certified financial planner that focuses on financial education and empowerment, okay? My motto is basically you have to make informed, educated decisions about your money and your financial future. And if you don't, somebody else will do it for you. So better to have some control over your money through education. All right, let's get started. Disclosure, I am a financial planner, but I'm not offering custom financial planning advice. There's a lot of regulation and compliance around when you're actually offering financial advice and planning advice. This is purely education. Okay, we're going to talk about types of insurance. What is indexed universal life? Its features, some things to know and to consider. The various riders or additional benefits that you can put on a policy. Take a look at the financial strength of a carrier, policy design, fees and commissions, and then have some question and answer time. Types of insurance. Well, in its simplest fashion, there's temporary insurance. It only lasts for a specific period of time. We call that term insurance. And a great analogy for insurance is, whether you decide to rent or own a house. When you rent and your lease is up, you leave and it's over. Same thing with term. If you buy a 20-year term, in the 21st year, the cost becomes so expensive that you basically are done, right? Permanent, however, lasts forever. Forever is a relative term as long as your premiums are adequate and are paid. There's many forms of permanent life insurance, okay, but it does not end when your premiums finish. Often you can have a permanent policy where you put your premiums in for 3 years, 5 years, 10 years, 20 years, or forever. The longer you pay the premiums, the lower the monthly premium is. We're going to talk about indexed universal, but there's variable universal, guaranteed universal, and whole life insurance, permanent life. These are all permanent insurance policies. Which is better? Well, there's really no one best insurance policy out there. It really comes down to what I say is what are your goals and objectives? And it's not necessarily what are your goals and objectives for life insurance, but what are your goals and what are your financial goals and objectives? And how can you best meet them? Because life insurance is really not just traditionally protection in case you die a premature death. It's also considered an investment. It is a bona fide investment class. Clearly, you need to educate yourself about it and always speak with a trusted financial professional. Third party, I say third party because, such as myself, before you go out and speak with an agent, always good to talk to somebody who is not necessarily trying to sell you something. Not all agents are bad, but just it's always good to be educated and talk to somebody who does not have a vested interest into whether you own a life insurance policy or not. Okay, definitions. Well, an indexed universal life policy, IUL, allows for you to allocate cash value to either a fixed account or an indexed account. Policies offer many well-known indexes to track. such as the S&P 500, the NASDAQ 100. They offer tax-deferred cash accumulation for retirement while maintaining a traditional death benefit. This is at the heart of indexed universal life. One of the factors we're going to talk about in several places in the workshop is really the flexibility of an IUL. That's really kind of its trademark. Is it allows you to adjust your death benefit and your premium payment and how often you make payments. It's very, very flexible. So it's easier to tailor or customize a policy to your individual requirements, such as cash flow. Now, in order to understand and have a productive conversation around IUL, you need to understand some of its core elements, cash value, right? The policy earns interest in either a fixed account or an indexed account, which helps your premium grow and increases the cash value accumulation and the growth in your policy. So an IUL is comprised of a cash value. You pay your premium each month, and based on how you design the policy, your money can go all into a fixed account, all indexed, or any percentage of both, just so that they equal 100%. The floor, when we talk about the floor, well, the fixed account and the indexed account have a floor, okay? And that's the guaranteed minimum level of interest you will be credited, guaranteed. The typical floor for a fixed account is between 2–3%. That's a very good floor, and we're given that today's interest rates some of the key rate indicators are negative, for the first time in history. But the floor, you always have to weigh these with the fees, which we'll talk about later. But for the indexed account, your floor is at 0. And we'll talk about that. You're guaranteed to never go below 0 on the indexed portion of the policy. The indexed account, well, many indexes and different insurance carriers offer different indexes. The Dow Jones, S&P 500, NASDAQ, Russell. You can actually track your growth or tag your growth within the policy to international indexes, Hang Seng, Eurostoxx. Important to know, your cash, your premiums are not invested in sub-accounts. If you've ever heard of variable universal life, its negative connotation, or I should say the risk, is that in variable, you're invested in the market. And if the market tanks, the insurance company could ask you to pay more premium. And if you don't have the money, the policy lapses. But an indexed account is not invested. It simply tracks the index, and and your account earns credited interest based on the performance of the index, subject to the cap and participation rate. Well, what is participation rate? Participation rate really determines how much your cash value will participate in the gains of the index. And this is more easily understood if we use an example. So let's say you're in the S&P 500 and in the index portion of your account, and the index returns 6%. And your participation rate with that carrier is 150%. So you would, instead of earning 6%, you would earn 9%, which is 150% participation rate, right? 6 times 1.5. And this would be credited to your cash value up to the cap. So what is the cap? Okay, well, the cap is the maximum amount of interest the insurer will credit you. And it really, these caps, actually caps and indexes and participation rates really vary, right? Depending on the carrier. Different carriers offer different caps, and the cap can vary significantly from one insurance carrier to another. So those are some of the basic terms that we'll use throughout this workshop. When we talk about the features, why you might want to consider an indexed universal life policy. Okay, the traditional use of life insurance is the death benefit, protecting your family, right? You know, you never be able to replace the loss of a loved one, but you really want to avoid grieving and having massive financial hardship at the same time. The death benefit provides a concept known as leverage, right? Same concept we use when we buy a house. We put 20% down to own a house worth $1 million. And if the value of that house goes up 3%, we actually earn 3% on $1 million, even though our out of pocket is $20,000 or $200,000. It really drives the rate of return up. Now, with a life insurance policy, you really get a lot of leverage in the beginning, right? A 20-year-old buys a $100,000 policy, and they may only pay $1,000 a year for $100,000 of death benefit. And that death benefit starts in day one, and that's the leverage, really. The leverage comes, you know, by owning a large death benefit for very little money in. Living benefits, I think, are really what's changed in the industry and why we really want to take a serious look at indexed universal life. This is protection during your life, while you're alive. You can access the death benefit during your lifetime for chronic illness, critical illness, long-term care assistance, and supplemental tax-free retirement income, living benefits. Now, should you access the death benefit during your lifetime, it will reduce the death benefit. So if you have a $500,000 death benefit and you become ill and you need $100,000, your death benefit would go down to $400,000, right? And you can add these living benefits with a rider. And we're going to talk about what are the different most common and relevant riders when you purchase a life insurance policy. Usually for an additional fee of 1%, give or take, you can place all of these living benefits on your life insurance policy, on the death benefit. I think this is truly one of the greatest improvements or enhancements in insurance that insurance carriers have made over the past, I would say, 5-7 years. Cash value. Okay, well, one of the greatest features is an IUL allows for cash accumulation and growth inside the policy, right? And you can always access this cash value during the life of the policy. Your withdrawals are tax-free up to the amount of premiums paid. You're basically putting money in and you can pull that money back out. That makes sense. But you can access the growth, the tax-deferred growth of your account by taking loans. This is a loophole. It still exists, and it's why people with a lot of extra cash around like to pump it into life insurance, because you can pull the growth out tax-free. It's only one of several ways that you can get tax-free income. Now, one of the things you really want to make sure is you don't want to put too much money into a policy. Otherwise, it becomes what the IRS calls a modified endowment contract. Now, not going into a lot of detail about this, number one, your illustration for the policy should very clearly state this is not a modified endowment contract. We call them MEC. And the term is, if the policy MECs, then when you take your money out, it's all taxable. This is very, very big, very important. No reputable insurance agent will sell you a modified endowment contract. They just won't, if they're reputable and they know what they're doing. But your IUL has a cash value, unlike term, right? Term, it has no cash value. It's like renting. You're not building equity in your home. It's like renting. When you're finished, you leave, and the money is gone. But an IUL is like really putting equity into a home, right? You're growing cash value. It's very flexible. Unlike term, it's flexible. With term, if you miss a payment, that policy will lapse. But IUL provides the ability to pay more or less each month. Now, there's a minimum that you can pay just so you cover your fees and your cost of insurance and that you don't MEC, right? But it has much more premium flexibility, okay? Locked-in gains and annual reset. I think next to the living benefits, this is the second greatest feature, is the ability to start from zero each year. We talked about floors in the definitions. IUL almost always has a floor of 0%. It'll never be negative, never be negative. If the market goes down 10%, you've made zero that year. If the market goes up 10%, you've made 10% that year. Of course, subject to the cap, right? So if you're all in the S&P 500 and it does 10% and your cap is 8%, you're going to get 8%. If it does negative 10%, you're at zero. You never have to struggle to catch up, right? Due to previous year losses. That's powerful. So indexing in action, I use this chart here for anything that uses indexing because it's a very easy way to understand the power of floors and caps. So here, in the early years of the investment, the market does negative. The yellow is the actual performance, right? The actual performance of the market. So let's say, well, these are actual historical results for the last 10 years in the market. And this says it went down negative 13%. But the index or the policy, the cash value, stays at zero. See, we're not talking about market value because you're not invested in the market. You're simply tracking an index. And the insurance company is crediting interest to your cash value each year. Cash value will never be less than zero, which is why this blue line only goes up and never goes down. The flat years are when the market is down because you get the floor is zero. When you have an up market, say here in year 3, the market went up 26%. But you're capped at 14% in this particular chart. This chart is actually from a while ago. I mean, we haven't seen 14% caps in a while since caps now are generally, depending on the index you're in, they can be anywhere from like 8 to 10%, maybe as high as 12%, depending on the index you're in. The more volatility the index, generally the higher the cap. But we'll talk about that as we move along. So just following this, right? Here you got the full 8.99 because it's under the cap. You got 3 because it's under the cap. You got 13.62 in year 7 because it's under the cap. Under the cap, oops, the market dropped 38%. I'm guessing this is 2008 right here, 2008, 2009. If you were holding a life insurance policy or an annuity for that matter, they're both insurance products, you wouldn't have lost a penny. And when the market went up in 2009 and 10, you participated up to the cap. This is a 100% participation in the cap, in the index up to 14%. So if we take, it's interesting, but if we take these 10 years and you held an index product, you would be way ahead of being invested directly in the market. Way ahead. Okay. All right. A picture is worth 1,000 words, as I always say. Another feature that I really like, and a lot of people like about IUL, especially when you, because it's an investment, right? And you're putting money in, you often want to compare it to IRAs and 401ks. Well, because you can take tax-free retirement income out of it. So it's kind of like the equivalent of a Roth IRA. But if you compare it against the IRA or 401k, there's no mandatory distribution in retirement. Life insurance, nobody will tell you you have to take money from your policy. But if you needed to, you could access your money pre-59.5 without penalty, which in a lot of retirement products, you simply cannot. You're going to pay a 10% penalty. And you know, this type of feature is great. For example, if your spouse is working and you're retired, you can live off the employment income. And if you don't need money out of this policy for retirement, you can let the cash value grow each year without being forced to take money out of it. So no required distributions or no required RMDs or penalties for early access. Okay. And of course, at any point in time, you can access the cash value via a withdrawal. It's considered a withdrawal of premium and a loan on the growth. Withdraw your premium, loan yourself the growth for tax-free income. Excellent growth potential. When compared to other forms of life insurance, Index Universal has incredible upside growth, right? But at the same time, when it returns a rate higher than the cap, the insurance company keeps the difference. And you know, that's basically part of them being able to afford to provide these features, right? They do a lot of hedging in the background. They buy options. They keep the difference in an up year. You know, they've got to make sure they can make a profit on this as well. In the down years, you have a floor of 0%, which we see as a huge benefit, right? When we were looking at the chart showing how indexing works. Another great feature is when you take money from an IRA or a 401k, it goes into your provisional income calculation, right? Distributions from, and if your provisional income exceeds the IRS threshold, then your Social Security will be taxed. Well, distributions from life insurance are not included in provisional income. So not only are they tax-free, but they do not go into provisional income and are part of the equation that causes Social Security to be taxed. So while the income from an IRA might put you over the limit, which is $32,000 filing jointly and $25,000 filing as an individual. In 2017 and 18 and 19 and 20, even though the cost of living has gone up, these thresholds are incredibly low. Every financial professional scratches their head about this because these do not adjust every year. So since 2007, these have been the limits. And if your income in retirement exceeds these limits, then your Social Security is taxed. But life insurance distributions do not impact this equation. Okay, some things that you want to understand about IUL has so many benefits, but there is a cost, right? There is a cost of insurance. And while one of the big selling points is that you never lose cash value because of the 0% floor, and the premiums are flexible, you have to be careful in the early years of the policy when the cash in the account must cover the cost of insurance for that policy. So while you have a floor of 0%, which is really more about tracking the indexes and performance, the premiums that you put in go right into cash value. And the growth goes right into cash value. But in the early years, and you're just starting out, the cash value has to cover the cost of insurance. So one thing you really have to understand is that, you know, you've got to always cover the cost of insurance. And it's not hard to do in IUL. In variable UL, it's scary. But in IUL, you've really got to just make sure that your cash value, right, is enough to cover the cost of insurance. And quite frankly, as long as you don't MEC, as long as you don't put too much money in, which is very clearly stated, an IUL will give you a range of premium. It might say you can put in $5,000 to $20,000 a year. You've got to be sure to put in at least $5,000 a year. But if you can pump $20,000 a year, get all of those benefits and not MEC. If you put in $21,000, you now have a modified endowment contract in that year, and everything you get out of it will be taxed. So just be cognizant that in the early years, you want to put in at least, always, as much premium as you can. And do your best to keep, so basically do your best, keep up with or exceed premiums in the initial years. I can't tell you how many people don't even understand that they can put in more when the cash is there to really enhance the benefits. Okay. Cost of insurance increases as you age. Now, I'll just give you an example. Whole life insurance will take the cost of insurance and average it over the life of the policy. Whereas index insurance, it increases as you age. And it's based on, you know, your age, your gender, your rating, you know, how healthy you are, and obviously the amount of death benefit, right, that you purchase for that premium. And it increases over time. Why? Because the insurance company has more risk the older you get. You're more likely to die. Pretty basic stuff. Now, but the real true intent of the policy is to decrease the net amount of risk as seen by the insurance company as you age, right? So what you really want to do is make sure when you're creating the policy is that you gradually decrease the risk as seen by the insurance company. And this really gets into good policy design. good policy design. And we'll talk about that in a future slide. All right. But a properly designed policy is one that provides enough cushion in the beginning years to protect your policy from the rising cost of insurance down the road. This all gets back to work with a trusted advisor, agent, financial planner when you're designing the best policy for you, and you'll be fine. You'll always be good. IULs can be complicated, no doubt. You know, there's just no doubt that this is a lot, and I try to always break things down to where you can understand them and have, you know, educated decisions around the subject. Complicated is not a big deal if you have a good agent that you trust and you're educated and you understand the basics and the things that we're reviewing in this workshop. It's going to be an issue if you don't have a good trusted agent, or if you just prefer to pay the premiums and forget about it. You don't want to do that. Any investment, and life insurance is an investment, right? You know, it's different from, a lot of people love to make insurance analogous to, well, auto insurance, homeowners insurance, etc. That is term insurance. The analogy to homeowners insurance is term. To auto insurance, term life insurance, right? But IUL is an investment. And with any investment, you just can't, you know, forget about it. You've got to stay up with it and review it once a year. It's a solid, reliable product, and it provides a set of benefits, right? And we've talked about those benefits: living benefits, death benefits, long-term care, tax-free income. You reset to zero every year. You never have negative performance, but you're capped on the upside, right? So on and so on, right? So as with anything that's worth it, you've got to take some time to understand it. How do we choose a carrier? Well, it all comes down to financial strength, and we have many ways to review the strength of an insurance carrier, right? AM Best, Fitch, Moody's, Standards & Poor's, and there's even an overall index that combines all of them into one, and it's called Comdex rating. And the closer to 100 you are, the stronger, the more financial strength the insurance carrier has. You know, everybody has different feelings about all of them. I like AM Best. It's the oldest out there. It has a great reputation, and it's really recognized as an agency that's dedicated to the insurance industry. All it does is review carriers, and the way they do it is they have two symbols that indicate their ratings. The first symbol goes from A++ to E, so A++, A+, A-, A, right? B++, it would be B++, B+, right? B-, all the way down to E. This is the financial strength of the company. The second symbol is a Roman numeral, and it's really about size, financial size. And that's so that you can do an apples to apples comparison of big carriers and small carriers, right? And you don't want to compare a small carrier, a regional carrier, to a global insurance carrier, right? It's just apples to oranges. So, and if it's Roman numeral 1, their cap is less than $1 million, but if it goes up to X5, which is 15, they have a market cap of greater than $2 billion. Strength versus size, you know, I really think if you're going to do this, you want to at least focus on strength. That is truly, I think, where most people put their time and energy. When it gets to the size of the company, size might be more correlated, not necessarily to strength, but to different features, right? Things like that. Always choose a life insurance company that has a rating of at least A-. So that's going to be A plus, and A++, right? Don't ever go below A- when you're looking at the A and M best. I guess, in addition to financial strength, customer service is really important. And for that, my favorite is JD Power. Check out JD Power, see how they treat their customers. Another consideration when you're thinking about carriers is non-captive versus captive. Some insurance carriers, such as New York Life, those agents can only sell New York Life. But if you go to maybe a Mass Mutual or an Allianz or a Prudential, they're non-captive, right? They can sell generally other products, right? So they're going to be more inclined to shop companies and get you the best policy, as opposed to they can only sell their own policy. So, you've got to think about that as well and what you prefer. Policy design, this is huge. I think I've just got one slide here, but please take away from this that policy design is key. Flexibility is really, I think, what distinguishes indexed universal life from the other permanent life insurance policies, right? It allows you to skip a payment if things get tight. You can increase your payment if you really want to sock away some money for future benefits. But the flexibility extends to the policy design. And, policy design and complexity, they can be two sides of the same coin. Just know that the options and incentives, so you really want to look at it as if you're buying a car. I love the analogy, the chassis. Well, every car has to have a steering wheel and wheels and doors and, and windows. There's just some basics to a car. Consider that the chassis. Same with an insurance policy. What are the basics? Well, it's got to have a death benefit. Doesn't have to have living benefits, but it has to have a death benefit. Things like that. So, and however, some carriers include long-term care and living benefits in the chassis. Some carriers say we're not charging for, the living benefits. That's in our core base policy. But yeah, if you want the return of premium, which says if I surrender the policy, I get all my money back, that's going to cost you. In the analogy with a car, that's like the equivalent of getting maybe alloy wheels or a really fancy radio, right? You're going to pay for that. It's not in the core baseline model, okay? But so your chassis plus the riders plus incentives and bonuses. Listen, this is a competitive industry and each company strives to be competitive. So they're going to offer you, hey, if you put in $100,000, I'm going to give you $15,000 in 10 years, or I'm going to give you $7,000 on day one. Well, how can you do this? Well, it's an incentive, and they've got all the statisticians and actuarians and everybody that says they can afford to do that. And that's how, when you're working with apples to apples, if you're looking at one AAA company or A++ company versus another, and you feel like the policy's great and the financial strength is great, maybe look and see what bonuses they're offering, right? It's no different than any I guess, competitive industry. What is a rider? Well, okay, I'm going to have to go quickly through these, but I want you to understand that there are many additional features, right? It's an asset. It's a wealth building tool, okay? It allows you to build cash value, protect your family, leave money for your loved ones, have income for retirement. It can pay for long-term care and chronic and critical care. Okay, for an addition, and again, for an additional fee, understand what comes with the base policy and what can I purchase additionally. There's additional benefits called riders, and you select these riders based on your financial goals and objectives. Waiver of premium. If you're diagnosed as totally disabled, pays your premium for the remainder of the policy. Guaranteed insurability. This one is extremely important. I think it should be on every policy, and it allows you to increase the face amount during significant life events. You know, marriage, birth of a child, or even as you get older and you're making money. Great rider to put on your policy, because you can increase the face amount without having to provide evidence of insurability. You don't have to go through all the testing. Disability income rider. This is, you know, instead of going out and getting a separate policy, you can actually have a guaranteed monthly payment to you should you become disabled. So not only can you get the premiums waived or get them paid for you, you can actually get a monthly disability paycheck. We've talked about the long-term care rider. If you cannot perform 2 of the 6 ADLs and your doctor gives you a note, you can access the death benefit to pay for long-term care. You can access, you don't need the 2 of the 6 ADLs, but if you get a chronic illness, right? Maybe heart disease, cancer, right? You can access the death benefit as a lump sum or monthly sum to give you more money towards your care. Critical illness will also give you money to pay for any critical illness expenses that you have. Some carriers will even let you take the death benefit while you're alive to pay your mortgage if you fall behind. Accelerated death benefits. This has been around a long time, and it's what I think almost every carrier has this at no additional cost, and it's you know, it's analogous to a viatical settlement. Long time ago, you had to sell your policy, right, when you became sick and you needed the money. You had to, because the carrier wouldn't give you the money. You had to die first. So basically, the industry has shifted and said, yeah, we're not going to make you sell your policy. We'll give you the money up front should you need it. Accidental, and you can use it for anything. Accidental death benefit. If you travel a lot and you die in an accident, you can get more coverage, right? Return of premium. If you, for some reason, want to surrender that policy and you've put a lot of money into it, for a fee, they will give you all of your premiums back. Yep. You can get into many different riders for business owners, right? Protect their business, key person insurance. You know, if a key person leaves, the insurance, if the key person leaves or dies, the insurance, if they leave, the insurance can be transferred to another employee, or it will, if the key person dies, it'll pay a benefit to replace that person. If that benefit can go to the company, to the spouse of the employee. It's really, business owners use insurance a lot. Okay, cost of insurance depends on the type of insurance. Oops, looks like I've got some annuity references here, but truly the cost of insurance varies depending on the carrier. But yeah, this slide is actually not up to date, so I'm going to go. We'll go over to the next slide, but stop and talk about life insurance fees. Now, cost of insurance is what we call fees, right? Cost of insurance is the base policy or the chassis. The cost of insurance on these policies, as we said, is high. it can be 5 to 7%, 5 to 7% per year. And it goes up a little bit each year. That's why you have to make sure in the early years you always pay your premiums, don't skip your premiums, and when you can, put more into it, okay? Not for the fear of it lapsing, but to keep it giving you the benefits. You can always go in and change the death benefit, it's so flexible, and reduce your premium, but you don't really want to do that. You don't want to buy a policy saying, oh yeah, if I get into trouble, I can always reduce the death benefit. You'd rather not go there. And then as you add the riders, whether it's 0.5% or 0.75% or 1%, then you add that in to the fees. Okay, they don't go up every year. They say they stay the same every year. Commissions, you don't pay the commissions. The commissions are paid by the insurance company, right? And the point here, because we're running out of time, is be careful. Large institutions are a pay-to-play marketplace. They vet the insurance carriers and they have strong companies. They're selling you great products, but they're selling you the products of companies that are basically paying them to sell their products. Okay? So just be aware of that. But you don't pay the commissions. The insurance carrier pays the agent or advisor that you're working with. Is the policy right for you? Well, let's get back to what are your financial goals and objectives. You can compare life insurance to other investments. Again, it's an investment. You're putting your cash into the policy, and for that, it's accumulating and growing and is there for you to access. Just like when you buy mutual funds in an IRA and you make your contributions every year and it grows or loses money, right? So with your trusted advisor or agent, sit down, have a discussion around risk and return, the additional benefits from the riders, what your financial goals are, and things like taxability. Do you expect to be in a high tax bracket in the future? Well, if tax rates are going up, it's going to affect everybody regardless of income. Things like that. You really want to have a good conversation with someone to determine whether an IUL is best for you. All right, right on time here. I've got 10 minutes, and I can open up the lines here. And if anybody, everybody's off of mute. If anybody would like to ask a question, we've got about 10 minutes. Does anybody have a question? Boy, I must have done a good job. You can raise your hand. I've unmuted everybody, but you can certainly unmute yourself, raise your hand. All right, well, I'll keep everybody unmuted. And how about I keep going and just chime in. This is one of my Lynne-isms. I have a bunch of quotes if you're interested, but I say always try to make an informed, educated decision when it comes to your money. If you don't, rest assured someone else will decide for you. You really want to make the decision, and you want to be able, even when you're working with someone else, you want to be able to have an intelligent conversation about the investment. And today we've talked about indexed universal life. Again, there are many types of life insurance, term versus permanent. Within permanent, there are many types, and each one has its unique benefits and features and things to watch out for and understand and know. Okay, so I hope I've helped you become educated. today on IUL, Indexed Universal Life. It really is, I think, the most popular insurance out there today. But rest assured, there are advisors that really poo-poo it. They tend to be the fee-only advisors, and the reason they dislike it is, quite frankly, they can't get paid on it. And this comes from, I was one of those advisors, but it's not, I loved insurance. I own it. I own annuities and life insurance. But I also, the only way I did business was not just fee only, right? If people really wanted it, I was able to sell them insurance. But there are a lot of advisors that won't sell insurance or annuities. And is it because they dislike it? No. They may try to convince you that it's not good for you, but it's really because they can't be paid for it. So come talk to me anytime. Subscribe on my website, celiafinancial.com. I'm building the content now. I'm basically taking baby steps with how I go about educating people and creating content. This right here will be available on my website, because this is being recorded, and I'll just put it out there. If you want to listen to it again, feel free. If you want to forward it to somebody, feel free to do that as well, or just have them come over to my website. You can ask me a question through the Contact Us, and I'll get right back to you, generally within a day or 2 days. You can book a meeting, right? You can book a 15-minute meeting to ask a few questions, and if we do more together, you can book a meeting online with me. As I said, I'm going to do more workshops. You'll be able to see the events every Wednesday from 12 to 1. I'm having sort of an open mic Q&A, so I kick that off tomorrow, April 29th from 12 to 1, and I call it Wealthy Wednesdays. Bring any questions about financial health, which I call financial wellness, and anything about making money and investing. And I'm happy to answer your questions every Wednesday from 12 to 1. And with that, if there are no more questions, or any questions, I should say, any more questions, but if anybody has any questions, by all means, you can ask me now or later. And I thank you, and stay well.
Thank you, Lynn. Good presentation.
Oh, thank you. Who's that?
Chris Norloff.
Hey, Chris, how you doing?
Good, good.
You're welcome. You're welcome. Very much. All right. Thank you, everybody. Take care. Bye-bye.